Hey guys, what's up? I'm Erin and welcome back to the channel. Who is the average American? I'm not talking about billionaires or the people you see featured in the news or the people flexing on social media. I'm talking about the everyday American in the everyday household. Income, debts, savings, net worth, what does that picture actually look like? And once we put it all together, I think you'll be surprised at what it says about the financial health of the everyday American. Let's start with income. The median household in America makes about $83,700 a year. That's up from about $67,000 a decade ago, but with rising costs of housing and healthcare and education, it doesn't always mean that people feel wealthier. Next is housing. The typical U.S. home is worth about $364,000. with an average outstanding mortgage balance of $252,000. And it's about 65% of Americans who own a home. But keep in mind, these numbers are skewed, and they're skewed in both directions, because about a third of homeowners own their home outright, but other homeowners are very highly leveraged. Now let's talk debt. The average credit card balance is $6,700 per person, but for households carrying debt, it's closer to $10,800. Auto loans, well, that averages out to be about $23,000. And the typical new car now costs about $47,500. Student loans remain heavy at roughly $39,000 per borrower. So where does this leave the typical family's wealth? The median net worth is about $193,000. The average, well, that's more than $1 million. But that number is skewed by the wealthiest households, so for most families, that median is a better picture. And now here's a surprise. Households, on average, spend just 11% of their disposable income on debt payments. Now, I found that stat absolutely shocking, and you may too when you think about it. Just 11% of disposable income going to all debt repayments, including mortgages? Well, that number is skewed downward by a third of homeowners completely owning their home outright. So yes, this number is skewed, but I thought it was pretty interesting when I read it. And as far as emergency savings, the cushion is pretty thin. The average household has only 1.5 to 2 months worth of expenses in liquid savings. And finally, let's talk retirement. On average, people say they expect to retire at 66. But the average retirement age in the US is closer to 62. And those 4 years matter because it means 4 less years of savings, it means less compounding, and it means a greater reliance on Social Security. The average 401k balance, well, that's about $138,000. But the median, that's closer to $87,000. So when you put this all together, the average American looks like this. Earning about $84,000 as a household, living in a $360,000 home with about $250,000 outstanding on a mortgage, carrying a balance on their credit card with an outstanding car loan, student loans, and holding a net worth just under $200,000, with only a couple months of emergency savings and aiming to retire in their 60s. Okay, so that's the snapshot. But what does this really tell us about the typical American? Are they thriving? Where are they struggling? What kind of lessons can we take away? For that, let's break it down a little bit further. Of course, it's incredibly important to keep in mind that averages only tell us so much. To really understand a financial picture, we have to break it down by age, because income, wealth, and savings changes dramatically across the course of a lifetime. Let's start with income. These numbers are for an individual full-time worker, not households. So think of what a typical worker would earn at each stage. In your early 20s, the median worker earns about $41,000. Often, this is your first real job paycheck. And keep in mind, it's only looking at full-time workers. By 25 to 34, Income increases to roughly $59,000 as careers take shape and promotions kick in. Income tends to peak in midlife around $70,000 for those age 35 to 44 and just under $71,000 for those age 45 to 54. These are the prime earning years, but also the years of peak financial pressure. We have kids, perhaps a mortgage, and even college costs. By the time 55 to 64 rolls around, earnings ease back slightly to about $67,000 as many people wind down their careers or perhaps shift to part-time or step back from high-stress roles. So there's a clear arc here. We have steady growth in your 20s and in your 30s, and then your income tends to peak in your 40s and your 50s, and then there's a gradual decline until retirement. Keep in mind what these numbers depict. These numbers are only looking at individual wages of full-time workers. So they're not counting part-time work, they're not counting side hustles, they're not counting investment income, pensions, social security payments. They're not even looking at a household as a whole and if there are multiple income earners in there, which is why the broader household picture might look very different. But income is only half the story. The real measure of financial health is net worth. So simply everything you own minus everything you owe. And that tends to dramatically increase with age. Under 35, the median is about $39,000. Modest and often weighted down by student loans or rent or perhaps that first mortgage. By your mid-30s to early 40s, it increases to about $135,000 as careers stabilize and retirement accounts grow. For those in their mid-40s and 50s, it more than doubles to $247,000. By 55 to 64, it's about $364,000, peaking between 65 and 74 at just over $410,000 before dipping slightly after 75 to about $335,000. Now, $364,000 at retirement age may not sound like much, and for some families, it isn't, and that's why savings habits matter so much. But context is everything. If you're part of a dual income household and you go into retirement with 2 Social Security checks that are quite robust, you might not need that much in the way of investments in order to maintain your lifestyle. Or if you're a single income household and you have only modest Social Security, this type of investment level may not allow you to continue the life you want. It depends on what your situation is. So while that figure may not sound like much on its own, remember with the right mix of income sources, Social Security, and savings, you can have a very stable retirement. The question isn't, where do I fall compared to the median? The question is, how do my resources align with the life I want to live? And remember, those figures are medians. The averages are far, far higher in every single category. By the time we get to 55 to 64, the average net worth is about $1.6 million versus the median at $364,000. This just shows how concentrated wealth at upper levels really skews these numbers. And finally, let's look at savings rates across generations, because this is how we're building wealth. Those final set of baby boomers still working but closest to retirement saved the most, about 12% personally plus 5% from an employer match. This is nearly a 17% savings rate, and only about 12% are utilizing a Roth 401k. The remainder are using a traditional, which may make sense since maybe they're focused on lowering their taxable income today. Gen X, they're in their peak earning years, and they're saving around 15%, 10% from their personal contributions and 5% of an employer match. Here we have 14% taking advantage of Roth options. Millennials contribute about 13%. 8.7% personally, and capturing a 4.6% average employer match. And nearly 18% are using the Roth 401k option, a clear bet on tax-free income later in life. And Gen Z, They're just starting out. They're saving about 11%, averaging 7.2% in personal contributions and capturing an average 3.7% employer match. And like millennials, 18% are already leaning into Roth accounts. So the big picture here is that the older generations are putting more away into savings, but the younger generations are placing a bigger bet on Roths and having greater flexibility with their income down the road. Before we go any further, I really want to pause here and remind everyone that there is no such thing as the average American, and what we're really looking at here are different life stages, and that each of us have our own unique challenges and opportunities and circumstances that cannot be captured by these numbers. These stats don't tell your story or any individual's story in particular, but because I get so many questions in this space on what the average American might look like, this video is my attempt to sketch that picture. But even then, the most important takeaway isn't whether you're above or below the average or the median, it's what your financial picture looks like and that you're making progress in your own life. Now, these stats on their own may have their varying degree of utility, but the real value is what we can learn from them. Every generation is doing something right, and every generation has something they could borrow from the others to improve their situation. So let's break it down generation by generation. First up, the boomers. They've been in the game the longest, and their track record has lessons for all of us. Lesson number 1, consistency compounds. Boomers have saved through recessions and headlines and hype, and currently their savings rate is an average of 17%. That is how wealth is built over time. What you can steal is this. Automate your savings. You're saving no matter what the world is throwing at you. And instate perhaps a no panic sell rule. So no matter what happens in the news, no matter what happens in the world, you don't sell, you stay invested for the long term. And if you're someone who gets a little uneasy when the market has its volatility, maybe you check your portfolio once a quarter, not once a day. Lesson number 2, simple beats clever. Use broad index funds, keep your fees low. The fewer moving parts, the better. The real engine of growing your wealth is not complexity, it's discipline. So what you can steal is simply to default right into low-cost index funds and let it ride. And perhaps here's what some boomers could borrow. Maybe a little bit more tax diversification. Maybe we lean a little bit more into a Roth, or if you're charitably inclined and at the appropriate age, maybe you take advantage of QCDs or qualified charitable distributions. Those could help to reduce your RMDs or satisfy your RMDs if you're at that age or down the road. But these are options that can lower your tax bill and give you greater flexibility with your retirement income. Next is Gen X. This is often called the squeeze generation because they're juggling kids and a mortgage and aging parents, but yet they're still finding a way to save. So lesson 1, guardrails under pressure. Gen X proves that you can continue to save even when life is complicated. On average, they're still saving 15% of their income. Yes, that does include the employer match, but it still counts. It's money going into your account. So what you can steal from this is maybe you set a savings floor. Maybe you don't let your savings rate dip below, say, 10 or 12%. You gradually try to increase it over time. If you get a bonus, you put part of that bonus into your investments. You do what you can to keep your savings rate stable and growing over time. Lesson number 2, risk management is wealth management. Term life insurance, disability insurance, emergency savings, estate documents, none of these things are exciting or flashy, but they're documents that you need or insurances that you need in place to have a rock-solid foundation to your financial plan. They're the things that keep things from blowing up. Here's what you can steal from this. Do an annual resilience audit where you check your documentation, make sure your beneficiaries are up to date, check if you need any updates to your estate plan, make sure you check on your emergency fund. Is it in place and is it healthy and robust enough to cover your expenses should an emergency happen, or does it need some replenishing? And also, while you're at it, make sure that you have the proper insurances in place because this may change over time. Here's what Gen X can borrow. Maybe they lean a little bit more into the Roth like millennials. This would give them greater tax flexibility when they eventually do get to retirement. And maybe they're willing to embrace more negotiations or career pivots like Gen Z. Now let's talk millennials. They've taken a very different approach, and there's wisdom here too. Lesson 1, tax-free tomorrow. They're choosing the Roth on purpose. They're trading today's deduction for tomorrow's flexibility. That is a long-run, high-value move. If your tax rate is moderate or you expect it to increase in the future, take advantage of that Roth 401k or that Roth IRA today so you can lock in these lower rates. And also, if your company offers an HSA option, that is a great account to take advantage of because you get triple tax advantage on your money. You get to put it in tax-free, it gets to grow tax-free, and when you eventually take it out for medical-related expenses, it comes out completely tax-free. Lesson 2, automate the right habits. Auto-enroll, auto-escalate, set it and forget it with index funds. Completely remove willpower from this process. What you can steal is turning on auto-escalation of 1 or 2% until you hit the higher savings target that you're aiming for. What millennials can borrow from other generations, from baby boomers, they can identify that it takes the long haul to build wealth, that you have to stay in the game. And looking at Gen X, we can learn that you don't have to stop your savings just because life gets complicated. You can still find a way to prioritize putting something away for your future. And finally, Gen Z, the newcomers. Even early on, they're showing us 2 powerful edges. Lesson number 1, start now, keep fixed costs low. An 11% savings rate in your 20s can beat a 20% savings rate in your 40s. What this generation has is time on their side. Even putting modest amounts away can be very impactful for your future. Steal this. Anytime you get a raise, put 50% of that raise towards your investments and put 50% towards your lifestyle. It's really the best of both worlds, and this allows you to hold back on inflating your lifestyle too much. Lesson number 2, skill stacking equals income compounding. Treat your career and treat yourself like your own portfolio. Invest in new skills, take classes and certifications, branch out into new areas, network. You want to do whatever you can to grow your income over time. This is your most powerful tool. What you can steal is knowing that an annual raise isn't always something that magically happens. You might have to ask for an inflation adjustment. You might have to negotiate with your boss. You might have to completely pivot and change companies or careers, but know that your income should be increasing over time, and it is something you will actively have to work on. What Gen Z can steal, again, they can look to the boomers and know that building wealth takes patience, and they're in the first stages. So what they need to do is just continue. And as they look at Gen X, maybe they borrow some of those risk controls. Maybe they know to build up an emergency fund for when life inevitably throws you a curveball. So here's the big picture. Benchmarking is motivating, but the only race that matters is the one you're running against your past self. Have you built up your income this year? Have you increased your net worth? Have you built up your cash reserves so your emergency fund is in a better place? Have you added new skills? If you can borrow one positive habit from a generation next to you and implement it this month, you're going to be ahead of the game. Now, what if we run some numbers and try to figure out what the future might look for these generations? We'll look at the actual numbers, the median net worth, as well as the median income at the respective ages, and how much each generation is saving, including the employer match, and see what this could grow to over time. We'll assume an 8% annual rate of return, and we'll assume a target retirement of 65. So for the typical 30-year-old with a median investment balance of $40,000 and the median income currently of about $60,000 and an 11% savings rate, over 35 years' time, they could grow a portfolio to $1.7 million. Running the same scenario, using the numbers for the typical 40-year-old, they could grow their portfolio to roughly $1.8 million in the next 25 years. Using the starting investing numbers for a typical 50-year-old and looking at household income, so just under $92,000 with a savings rate of just over 15%, they could grow this net worth to $1.2 million by the age of 65. And finally, for those 60-year-olds, using the median net worth and the household income and a savings rate of 17%, well, they could grow their portfolio to over $600,000. Now, of course, these aren't perfect predictions. Everyone's situation is going to look different. It doesn't look at income growth over time. It doesn't consider spending habits or investing habits, but what it does show us is how powerful compounding can be. Notice how much runway younger generations really have. A 30-year-old starting with a modest $39,000 can end up with nearly the same balance as a 40-year-old who starts with 3 times as much, simply because of time. It also shows how the math changes over time. If we look at a 60-year-old who has a pretty strong investment portfolio and a strong savings rate, we still see limited growth because they have a shorter time horizon. The trade-off is time versus contribution size. The earlier you start, the less heavy lifting you have to do. Remember, there is no one size fits all. These averages don't tell the full story. Some people retire at 55 with millions in the bank. Others delay retirement and rely heavily on Social Security. Most of us will fall somewhere in between. No matter where you are, there are next steps you can take. And some of those best ones are to start if you haven't. Try to increase your savings rate over time and just stay consistent. Because at the end of the day, the question isn't how you stack up next to some average, but it's, are you building the version of financial freedom that works for you? I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Is it offensive to say just boomers on its own? I feel like culturally it's there more often, and I don't want it to be offensive. I read it, and I've read articles, and the articles in Kiplinger, in Money Magazine, and Forbes, AARP, they say just boomers, but I feel like it could be offensive. Should it be baby boomers? I don't want to abbreviate if not given the permission. If you're in that generation, let me know what I should say, and I will say it how I should.